Silver went up every single week, it seemed, in November and December. So the rebalancing was bad enough. When you add on to it the margin increases of 300%, which just came down as of Friday's close by like 17% in silver because of the low open interest.
21.4% now.
No one can play in that sandbox. It's too expensive. It's killed the refiners. It's hurt our business. It's hurt anyone who hedges or anyone that speculates. My feeling is this: the froth, the speculative froth in both retail and, which really doesn't amount to much, but also on the COMEX, has been literally obliterated. There is no more retail speculative froth or even speculative froth on the COMEX. That selling has ended up in the hands of very strong traders. But let's talk about something interesting. You know, I talked on this show a lot about how in February there was about 26 million ounces delivered into COMEX, which is a little bit on the low side of the past 18 months where we've seen these massive deliveries. But we saw 39 million ounces actually leave COMEX, which is 2 million pounds got in trucks and drove away.
Gold and silver are no longer moving like ordinary commodities. The recent sell-off looks less like weakness and more like a structural reset, where speculative money was forced out while stronger hands quietly took control. Andy Schectman explains that silver's sharp decline was driven by extreme margin increases, ETF rebalancing, and pressure inside paper markets, not by collapsing physical demand. Meanwhile, as prices fell, large amounts of silver were leaving COMEX, China was paying major premiums, and both China and India were treating silver more like a strategic monetary asset. The bigger message is that paper prices may be hiding a much tighter physical market. If deliveries keep rising while registered inventories remain limited, pressure could build quickly. Schectman also notes that major banks now talk about gold between $6,000 and $8,000, and silver possibly reaching $150 to $350 if this physical squeeze persists. This is why investors are watching gold and silver more closely than ever. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
That the only environment that gold and silver can move higher in is one of lowered interest rates, which is very convenient. Obviously, that is true to a degree. That's Gibson's paradox, where the price of gold moves inversely to real interest rates. In other words, if you have high interest rates in U.S. treasuries, people would buy treasuries with safety instead of gold, which pays no interest. But something very interesting happened this time. And that, first of all, let's real quick before I mention that, what is convenient about it is let's go back to 2019. Gold was 1,800 and the federal funds rate was 0. And then what happened? Well, we saw the steepest increase in interest rates percentage-wise in history, from 0 to 450 basis points or 4.5% in 1 year. And yet gold is now almost triple of what it was then. So a rising interest rate environment did not hurt gold. For the same reason that we saw this time. In other words, it was orchestrated by the CME group and by the market in large. So the first week in January, all ETFs that need to be balanced according to their prospectus need to be rebalanced. It's a notorious time of the year for when you see great volatility because these assets, these ETFs that have such a outwardly large, outsized large effect on the price of whatever market you're talking about have to be rebalanced. Silver went up every single week, it seemed, in November and December. So the rebalancing was bad enough. When you add on to it the margin increases of 300%, which just came down as of Friday's close by like 17% in silver because of the low open interest.
21.4% now.
No one can play in that sandbox. It's too expensive. It's killed the refiners. It's hurt our business. It's hurt anyone who hedges or anyone that speculates. My feeling is this, that the froth, the speculative froth in both retail and, which really doesn't amount to much, but also on the COMEX has been literally obliterated. There is no more retail speculative froth or even speculative froth on the COMEX. That selling has ended up in the hands of very strong traders. But let's talk about something interesting. You know, I talked on this show a lot about how in February there was about 26 million ounces delivered into COMEX, which is a little bit on the low side of the past 18 months where we've seen these massive deliveries. But we saw 39 million ounces actually leave COMEX, which is 2 million pounds got in trucks and drove away. Very big. Who's taking possession of 2 million pounds of silver? Where's it going? Is it the government because of the the project
Military,
vault
yep.
and the strategic nature of silver, now critical mineral. But let's talk about China, who is still maintaining a $10 per ounce premium over the Western price. And in February, they had their largest import month ever in the history of recorded numbers, import-export numbers ever. March beat that too. And so February and March, when silver had been decimated, the second largest producer of silver in the world imported more than at any time in history. What does that tell you? At the same time, you see India now, who has monetized silver to use as collateral. So you have India and China who are looking at silver in a monetary and in monetary sense, and in a sense that physical possession is far greater than anything held on the COMEX exchange or on the LBMA. And the paper price, which was driven down, according to the BIS, in a structural, synthetic, orchestrated manner, played right into the hands of a country like China, who for 2 months in a row imported more than any time in history. What does that tell you? Along with 2 million pounds of silver driving out of COMEX in February. Now we'll see the May delivery, which goes off the board in 2-3 days on Thursday.
Yep.
And the amount of open interest versus the amount of, it's like 175 million ounces of open interest, I believe, but there's only 70 million ounces or so in the registered category. What could possibly go wrong? Here's inventory in the warehouse. Here's hedge. We hedge, try to do everything 1-to-1.
As soon as this one's sold,
If one goes up, the other goes down commensurate. We're market neutral. As soon as one sells, we unwind one and place it upon the order. Unwind that when the order pays. The bottom line is we are hedging our inventory, so we're market neutral, so that when the price falls by 30%, your inventory of 2 million ounces, let's say it's worth at $70 an ounce, what, $140 million doesn't just get destroyed and lose 30%. You offset that by the gain on what you sold short. It's not something we do because we want to. We do it for survival, so that we are not speculating with inventory. GLD and SLV are both administered by JP Morgan and BlackRock. JP Morgan paid the largest fine the Justice Department ever handed out at that point, $920 million for manipulating the market. You can never take possession of GLD or SLV. It's a paper representation of the metals market. If you read the prospectus, I think it's page 6-12, called Risk Factors, it'll say things such as, the custodian, JP, is not responsible for the errors and or omissions of the sub-custodians, who they do reserve the right to employ sub-custodians. They are not entitled to visit the premises of the sub-custodian vaults. And if the sub-custodian's metal does not meet London good delivery standards, i.e. lead bar painted gold, they are not responsible for it. You are paying a 28% collectible capital gains rate when you sell it. You can never take possession of it. You're paying BlackRock and JP a 50 basis point management fee. You are eligible for capital gains taxes on that, not the collectible rate.
you can take delivery.
But the delivery is a 400-ounce gold bar,
Correct.
which you
Or
have to go to
10,000
the
ounce.
RCM to pick up,
Right.
or 10
10,000.
1,000-ounce silver bars.
Correct.
Good luck on both.
Yes.
It's not practical. You're paying a 40 basis management fee. Instead, own the real thing. You could store it in a Brinks facility for less than that, and deduct the storage fees, which are tax deductible.
The important shift is not just price action, it is ownership. With weak speculative positions shaken out and physical silver moving into stronger hands, this pullback may be less an end than a reset before the next phase. Andy Schectman argues that COMEX pressure, margin hikes, and ETF rebalancing created an artificial sell-off. Yet behind the scenes, silver was leaving warehouses, China was importing at record levels, and premiums in the East remained far above Western prices. This diverges from the narrative of a dead market. He also warns of the real danger, counterparty risk. As more nations bring gold home to reduce Western vault exposure, they prepare for a changing monetary landscape, where, when trust leaves the system, physical metal matters more than paper promises. Let's get back to the interview.
Well, the mainstream won't tell you. One of the big Swiss banks, and the name escapes me, it's not one of the main ones like UBS, but they sold a bunch of their metal based upon the structural side of the market collapsing, and they, after the BIS came out and announced that this was not fundamental, it was purely orchestrated through increase in margins and rebalancing of ETFs, they came back in and think, like all the other banks, between $6,000 and $8,000 by the end of the year. They're all saying it. And now Bank of America is saying between 150 and 350 in terms of where they think silver will end up by the end of the year.
Yeah.
Within a governmental pre-approved program, to me, it's a false sense of security to have assets in Singapore or Switzerland. They'll tell you the IRA is now closed, bring back your money, period. To me, it is it's kind of oxymoronic, if you will. It sounds good, but in practice, because it is inside the wrapper of a IRA or pre-approved IRS retirement vehicle, it's not worth it. So the answer is no at this point. We are working on things that will allow greater utility within the IRA for different types of gold programs. The first day of delivery, first day notice is Thursday. Every single time they're able to miraculously get that open interest way down, but it's getting harder and harder and harder to do so. There will be a good amount of silver that stands for delivery. And it just is going to show, again, it speaks to just like, I admire the Chinese for the way that they have slowly accumulated metal, not to cut off their nose to spite their face or to immediately alert the industry or the world and to upset the apple cart. If you are trying to remove your metal, exit, get it out to exit the stage left, you have to do it slowly.
Yep, methodically.
And that is, and again, you look at February, 160% of what deliveries could explain alone left COMEX. 25 million, 26 million delivered, 39 million ounces left. About a week later, a couple Fridays ago, 2 million ounces left the eligible category. Those bars aren't even for sale. Those are like within our storage program. So people are pulling it out slowly enough as to not, I think, trigger force majeure or some sort of cash settlement. As far as gold being revalued, we are broke. We are, in essence, almost 40 trillion in debt. That doesn't include the unfunded liabilities of Medicare and Medicaid and Social Security and government military pensions that are all in total of everything about 200 trillion in debt. The U.S. government has a balance sheet of about 5.5 trillion, the largest asset being student debt. So we are broke, and very much so. And so, yes, the rebalancing or the revaluing of gold is in essence how you reset the dollar. You let gold go much, 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 much higher, and the dollar goes much, much, much lower. This is how you reshore manufacturing. So think about that. Sulfuric acid is what you need to mine and produce copper. Silver is largely a byproduct of copper mining. Only
75% roughly.
Only 15% of all the silver mined last year came from
silver mines.
So not only in 2025, China was a silver exporter to the world, to all the world's markets. This year, they are a net importer, which if you go back to November, they're the second largest producer in the world, and they said, we will no longer provide any of our domestic mine supply to the world. Then in January, when we classified silver a critical mineral, they came out and said, we're going to massively curtail exports. So now they are importing instead of exporting. They're curtailing exports. They're not selling domestically mined silver. And then
they're cutting off
say we're cutting off supply of sulfuric acid,
right,
which is used in copper production. Do you think all of these things are by coincidence? All of the metal that once was, for example, look what France just did. France just they didn't take back all their metal. They did, but they sold it to the Fed and repurchased it because the metal that they supposedly have been holding at Fort Knox is coin melt from the 30s. Therefore, it's not 24 karat. It's 20 or 22 karat, I guess it would be, from the old $20 gold pieces. And those don't meet
the requirements,
24 karat international requirements. So they sold the gold back to the Fed and then bought in 3 or 4 tranches. All of the gold that they had at the New York Fed, it's gone. But that follows the Dutch Bank, the Bank of Austria, the Bundesbank, Hungary, Turkey, Poland, the Czech National Bank. All of these banks brought their gold back from the Bank of England and the New York Fed, which would give great ease in trading on COMEX and the LBMA. They would rather forego the easy transaction in favor of having no counterparty risk. We're seeing this everywhere. Treasury yields rise. We don't trust the Treasury. Dollars being sold. We don't trust the dollar. We don't trust the markets. And so removal of counterparty risk is not a dumb thing. And when you watch David Rogers' Web, the great taking, the changing of the Universal Commercial Code, which stood court challenges in the 2008 great financial crisis, nothing else really matters. And so, yeah, we may be crazy, but I sleep very well at night.
Yeah.
What makes this discussion so important is the gap between the paper market and the physical market. On the surface, silver looked weak after a sharp correction, but beneath the surface, the signals were completely different. Record imports, strong Asian premiums, COMEX withdrawals, and growing demand for physical possession. Andy Schectman's message is clear. The system is being stressed from multiple directions. Silver is now viewed as both an industrial metal and a strategic asset. China has shifted from exporter to importer. India is monetizing silver as collateral, and major physical flows are moving away from Western exchanges. At the same time, central bank gold repatriation shows that countries are reducing counterparty risk and preparing for a world in which trust in paper claims is weaker. The prediction side is also serious. If the pressure continues, Schectman highlights forecasts from major banks calling for gold in the $6,000 to $8,000 range and silver in the $150 to $350 range. Those are not small moves. They suggest a major repricing of real assets. For investors, the lesson is simple. Paper volatility can distract from physical accumulation. Share your thoughts below, and if you enjoyed this analysis, like the video, subscribe, and turn on notifications for more updates.